Welcome to our deep dive into Sun Pharmaceutical Industries Ltd, a titan in the global healthcare space. Founded in 1983 by Dilip Shanghvi, Sun Pharma has grown from a small psychiatry-focused startup into the world's fourth largest specialty generic pharmaceutical company. Currently listed on the NSE under the ticker Sun Pharma, it commands a massive market presence with a market capitalization exceeding 3.8 trillion INR. For investors, Sun Pharma represents a blend of defensive healthcare stability and aggressive growth through its specialty medicine portfolio. Today, we will analyze its business model, financial health, and strategic direction to see if it earns a spot in your portfolio. Understanding Sun Pharma requires looking beyond the pills and into the complex ecosystem of global supply chains and regulatory excellence. Sun Pharma's strength lies in its diversified revenue streams. It operates primarily through three segments: specialty medicines, generics, and global consumer healthcare. The specialty segment is the company's crown jewel, focusing on complex areas like dermatology, ophthalmology, and oncology. This segment alone contributes roughly 16 to 18% of total revenue, but offers much higher margins than traditional generics. Meanwhile, their generic business provides the high-volume base required for massive scale. By balancing these high-margin innovations with steady-demand generics, Sun Pharma creates a resilient business model that can withstand pricing pressures in any single market. This strategic shift towards specialty products has been the primary driver of their recent stock re-rating. When we look at the numbers, Sun Pharma's financial trajectory is impressive. For the fiscal year 2024, the company reported consolidated revenue of approximately 48,497 crore INR, representing a steady year-on-year growth. Even more critical for investors is the EBITDA margin, which has consistently stayed around the 26% to 28% range, showcasing operational efficiency. The company's net profit has seen a significant upward bend, driven by cost optimization and the scaling of the U.S. specialty business. Furthermore, Sun Pharma maintains a strong balance sheet with a low debt-to-equity ratio, providing them with the dry powder needed for future acquisitions. This financial discipline is a hallmark of the Shanghvi leadership style. Sun Pharma is truly a global player, with a presence in over 100 countries. India and the United States are its two most critical markets. In India, it is the market leader with over an 8% market share, boasting a sales force that covers nearly every doctor in the country. In the US, it is the largest Indian pharmaceutical company, competing successfully despite intense regulatory scrutiny. Emerging markets like Brazil, Mexico, and Russia also contribute significantly, providing a hedge against currency fluctuations in developed nations. With 43 manufacturing facilities globally, Sun Pharma possesses a vertical integration capability that allows it to control costs from the raw active pharmaceutical ingredients all the way to the finished dosage. Innovation is the engine of Sun Pharma's future. The company invests roughly 5 to 6% of its total sales back into research and development every year. This translates to thousands of crores dedicated to building a robust pipeline of specialty and generic drugs. Currently, they have over 500 abbreviated new drug applications, or ANDAs, filed with the US FDA, with many still awaiting approval. Their R&D focus has shifted from simple generics to complex generics and new chemical entities. This strategy is designed to create products that are difficult for competitors to replicate, ensuring long-term pricing power. For an investor, this R&D spend is not just an expense. It is the capital expenditure for future market dominance. Sun Pharma has been a wealth creator for long-term shareholders. Over the past few years, the stock has outperformed many of its peers in the Nifty Pharma Index. When analyzing its valuation, investors often look at the price-to-earnings, or PE ratio. While it may trade at a premium compared to some smaller generic players, this premium is often justified by its specialty pipeline and consistent cash flows. Historically, the stock has shown resilience during market downturns, acting as a defensive prey. However, it is sensitive to US FDA news and healthcare policy changes in the United States. Analysts maintain a generally bullish outlook, citing the growth of the Illumia and Cequa specialty brands as key catalysts for future valuation expansion. No investment is without risk, and for Sun Pharma, the primary challenge is regulatory.
The US FDA frequently inspects manufacturing facilities, and any Form 483 observations or warning letters can lead to product launch delays or import bans. We saw this with their Halul facility in the past. Additionally, the pharmaceutical industry faces intense price erosion in the US generic market as buyers consolidate and competition increases. Currency volatility also plays a role, as a significant portion of earnings is in dollars and euros, while costs are often in rupees. Finally, the high cost of clinical trials for specialty drugs means that any failure in phase 3 trials can lead to significant R&D write-offs. Investors must monitor these regulatory updates closely.
In conclusion, Sun Pharmaceutical Industries is a mature giant that is successfully pivoting toward a high-margin specialty future. With a dominant position in India, a recovering U.S. business, and a disciplined approach to R&D, it remains a core holding for many institutional investors. For the retail investor, Sun Pharma offers a way to play the global healthcare theme with a company that has a proven track record of navigating complex regulatory landscapes. The key to watching the stock lies in the growth of its specialty portfolio and its ability to maintain its 27% EBITDA margins. As always, consult with a financial advisor, but Sun Pharma's fundamentals suggest it will remain a leader in the global pharma race for years to come. Thank you for joining this analysis.